Welcome to Brick by Brick, Building Wealth Through Homeownership. I am Kim Von Dohren, your realtor.
And I'm your banker, Ed Marko.
So today we're going to talk about interest rates and, more importantly, your payment amount. We are so programmed to believe that the interest rate is the most important thing that affects our payment, but we're going to talk about some other things that may be more important. Is that right, Ed?
That is correct, yeah. So particularly in this market, it's important for people to understand that the interest rate does affect your payment, and it does have somewhat of an effect on your borrowing power, but it's not nearly as large as a lot of other things that spin around that monthly payment. Your monthly payment is made up of 4, possibly 5 or 6 things, but mainly it's what they call PITI: principal, interest, taxes, and insurance. So the principal and interest is the part that is affected by the interest rate. The principal is the amount that you've borrowed, and the interest is the fee that you pay to borrow that money. But the taxes and insurance are oftentimes a greater percentage of your borrowing power is affected by that than the interest rate. So there's more than just interest rate on your payment.
And taxes can vary widely from property to property.
Taxes and insurance and other, not just your homeowner's insurance, but if you're putting less than 20% down, you're going to pay private mortgage insurance or MI. And that can swing wildly. And you have control over these things. On the mortgage insurance end of it, if your credit is not very good, you're going to pay a much higher rate than if your credit is very good. On a typical $300,000 home, if you've got a 620 credit score, your PMI, your mortgage insurance, is going to be in excess of $250 a month.
Wow.
Yes. Whereas if you have good credit, say you've got a 780 credit score, your mortgage insurance might only be $60 or $70 a month. So that's a huge variable there. That's really, and what you've got to realize, what people I think are unaware of, is every $100 that you're paying for something other than your mortgage affects the amount you can borrow by about $15,000. So if homeowners insurance or insurance on one side is $250 a month, and on the other side it's $150 a month, that $100 difference is $15,000 in borrowing power, less or more, depending on that variable.
Right.
So I think the first thing I want to talk about is the history of interest rates. Like, people are all up in arms about rates. I'm going to go back 50 years. So like from 1971, in 1971, the interest rate on a 30-year, I'm talking 30-year fixed rate mortgages, by the way, was about 7.5. By 1979, the interest rate was 11.25.
Okay, so let's just have a pause there for a second. So 1971 at 7.5, we're not that far off the mark to where we are today.
Right, still higher than we are today. But
yes,
yeah.
But we creeped up into those numbers in the last 2 years, right?
Correct. Yeah,
we did.
Yes,
okay,
we did.
And then by 1979,
11.25.
11.25, which
Right.
is a good credit card rate today, but it is not a great mortgage rate.
But it got worse. By 1981, in fact, in October of 1981, we hit the highest we had ever been and ever were since then, of 18.4%.
18.4%.
18.4%.
So here's a question, and you may or may not know this. What was the average cost of a home in 1981?
Somewhere between, I think, $50,000 and $60,000.
Okay.
It costs much less. Yeah.
It costs less, but everybody earned less.
Everybody earned less.
Mm-hmm.
A new car back then was probably around $11,000. And the interest rates on car loans was even higher.
Do you know what was related to that increase in a matter of 2 years?
So it had everything to do with, was mostly political. It had to do with inflation, all of the factors that we have at play today.
Okay.
It's just pardon me, you we weren't good at managing it. So in 1973, we came off the gold standard. And that really changed the way that the government was allowed to print money. So over the course of the first decade of that, they kind of lost their minds.
I see.
And that wreaked havoc with all parts of everything. Finally, by 1989, there had been a change in administrations. Everybody got very much more conservative when it came to printing money. They reined everything in, and interest rates went back down, and they were cut in half by up to about 9.75 by 1989, or about 10%. By 1990, they actually hit 10%. By 1998, about a decade later, they were back down to 6.9. They kind of stayed around there. In 2000, it was 8%. By 2009, we had another market crash. The banks were credit unions in particular were in trouble. The housing market was just in turmoil. There were so many speculators out there that everything crashed.
So I just want to take a moment to acknowledge that that was an extreme and abnormal thing that happened in the market.
Yeah. Yeah.
There were a multitude of factors that created that. That's a whole podcast in and of itself.
Right.
But that was not a normal blip on the economic radar of life. Correct?
Right. So there's two things that happened over the last 50 years. You had that runaway inflation in the late 70s that caused those super high interest rates in the early 80s. And then it kind of normaled back out again. And then we had in 2008 and 2009, we had a lot of really bad lending going on, a lot of speculating, a lot of bad investors. They were making loans. Well, I was going to say we were making loans that were stated income loans. So you could literally, if you had decent credit, a lender would say to you, in order to afford this, you would need to at least make $200,000 a year. How much do you make? Oh, I make $250,000 a year. Somebody could be working at McDonald's and say that, and the lender was required to believe them. So it just you set this. There was a lot of other factors, but that was the big one in my mind. Just insanity. So it crashed. Everything crashed. And then to try to get things stimulated again, they came out with a thing called QE, or quantitative easing.
Who came out with?
The Fed.
Okay.
So the government said, we need to do something to, real estate stopped selling. Everybody just stopped. We needed to do something to get this going again. So they artificially lowered the prime rate, which is what banks borrow money from the Fed for overnight.
To give loans.
To give loans. And that held interest rates like from 2010. In 2010, the interest rates on a 30-year fixed was 4.8. By 2019, it was 4.13. And it kind of stayed like that, just stayed like that. Now, then something happened. We all remember something that happened in 2020. We had that thing. And that also kind of stopped the world. Not kind of, it literally stopped the world.
Literally.
And then to restart the world, instead of just waiting for things to naturally occur, we doubled down on that quantitative easing, and we pushed interest rates lower and lower and lower until we were buying money from the Fed at 1. So we were selling it at 3.15. So in 2021, you had an interest rate on a 30-year fixed rate mortgage of 3.15. You had 20-year and 15 years in the 2s, but this was all artificial. They pushed it down until finally it could hold no more. And it let go. Everything kind of blew back up again. They raised the rates because we had inflation happening and they needed to end that. So they kept raising rates until by 2023, the interest rates were back over 7.5.
Right.
And here we are today waiting for all these things to change. Now, here's the interesting thing about this, and this is why I wanted to tell this story, is the average interest rate over the last 50 years is a little bit higher than 7, kind of approaching 8%, depending on where you measure it. There's 12 central banks across the United States, and each one is its own market. So you got to average all that out. So if you average it all out, somewhere between 7.5 to 8% is the average interest rate. Now, right now, without dating the podcast, we're below that.
Right.
We are below that. Anytime we're below that, we should realize that that's normal. That 2 and 3% interest rate is not normal. That 18% interest rate is not normal. Somewhere under 7% is normal. Somewhere over 4% is normal. And that's to my point. If you're talking about normal interest rates and you're saying to your real estate agent or in your head, I'm just going to wait for interest rates to get below 6, and it's 1981, you're going to wait 22 years to buy a house. And you're going to lose out on all of that appreciation and all of the money that you're not putting into that house, and you're going to rent. And
And
just
we all know what you leave with when you rent.
you leave with your sofa.
That's right. You leave with your furniture. That's
Right.
all you leave
That's
with.
all you leave
No
with.
equity.
Zero
Yeah.
equity. Right.
Yes. Yeah.
So that waiting is not the good answer. But so that you feel good about it, you need to understand some things. So the difference in your mortgage payment, let's say you're looking at a $300,000 house and you're only putting 5% down. So you're going to finance $285,000. A 1 point difference in your interest rate is less than $200 a month. A half a point difference in your interest rate is slightly less than $100 difference a month. So let's say interest rates fluctuate a quarter to a half in any given market cycle, which is really what they did do for decades. What things affect it more than that $100 a month?
Can I ask a question before we move forward?
Yes.
Why do you think so much emphasis around buying a home is on interest rates? Because it is. That's what everybody is concerned about, what the interest rate is. And, I think at some point in time we should do a podcast on the Fed. I heard you say printing paper. I heard you use language that I'm going to guess some folks maybe aren't familiar with. The Federal Reserve is like a kind of a thing that is like an enigma people don't really understand either. And so we can talk about those at some point in time.
Yeah, that's a great idea. Yeah.
Yeah. So I lost my train of thought around what my question was. Did I get any of the question out in the beginning of what I started to
Yeah.
say?
So why is everybody fixated on
Yes.
interest rates?
Yes.
Yeah, I think people fixate on interest rates because it's mystical and they don't understand it, and they can point their finger at it and go, that's the reason I'm not going to do this, rather than take the leap. Because it's a big leap. Buying a house is a big, scary thing to a lot of people.
Absolutely.
And that's the one thing you have no control over. So what I want to do with this podcast is talk about the other things that you do have control over,
Right.
and maybe it'll take some of the horror out of all of this.
Yes.
So I think did that kind of
Yes.
answer you? Okay.
Yeah.
So
I think it's also a cost associated with borrowing. And so everybody wants to have their costs associated with borrowing be the least amount they have to be.
right.
Yeah.
So knowing we can't control interest rates, what can we control?
Right. Because we cannot
You
control
cannot.
interest
No,
rates.
no.
And, we can also do a podcast on, what does the Fed do? Right.
Yeah.
Why do they raise rates? Why do they lower rates? But what happens when they do that and things like
Right.
that?
We can try. I can tell you that's a college course. It's not a
Yeah.
it's not
We're just
half-hour
trying to give
podcast.
people enough information that they can have a basic understanding.
Right.
No in-depth understanding. I don't have
Right.
one myself.
Right. So anyway, I want to so to get back to that, you can't control the interest rate. So what
Right.
can you control? Well, you can control your taxes to a degree. So we're in a county where in town the tax rate is super low compared to what the tax rate is, say, in a suburb of town, of the city. So as an example, I just took two examples. These are real examples from our market. A $300,000 house in the city. By the way, this is a pretty large house for $300,000.
Mm-hmm.
The taxes on it every year are $1,972. This is almost a 4,000 square foot home, huge home. That same $300,000 in the suburbs, buys you a 3-bedroom ranch home with 1 bathroom. This is not
1,600 square feet, maybe
just
1,100
yeah, yeah,
square
exactly.
feet.
Though this particular one was actually 1,800 square feet, so it
Okay.
was a sizable ranch home. But the taxes on it are $5,643 a year,
Yeah.
or $470 a month. So you're on that home in the suburbs, you're paying 470. On that home in town, you're paying 165. That's $300 difference. If you're buying a home in town, you can actually afford $300 more. Every $100 gets you how much more borrowing power?
15,000.
15,000. You can afford $45,000 more house in town than you can in the burbs. Now, that's not for everybody. Some people absolutely despise living in the city. Some people will only live in the city. So you need to be aware of that though. The other thing is, this is an extreme example. I can tell you that I live just outside of town in the burbs, and where I live, we have an incredibly high tax rate. If I just was willing to move, and I am unwilling to move, but if I was willing to move 3 or 4 miles east of where I am, my tax rate would be half of what it is here. So for most people looking to buy a home, that 2 or 3 miles isn't a life changer for where you're living, but it can make the difference of, 15, 30, 45, $65,000 worth of house is the difference there. Same thing with your homeowner's insurance. You need to shop for homeowner's insurance, and you need to understand how that works. If you're insuring a $300,000 home and you've got a $1,000 deductible, you're going to pay, if you got an umbrella policy and all this other stuff, about $3,000 a year, according to my agent. But
It's too much, by the way.
it is, it's very high, right?
That's too much.
So, and she said that's crazy. That's why she wouldn't recommend a $1,000 deductible.
Mm-hmm.
If I have a $5,000 deductible on that same policy, it's $2,000 a year. And if I'm willing to go with a 2% deductible, it's $1,200 a year. And the difference between those two policies, same amount of coverage, just different deductibles. One is $250 a month, the other's $100 a month. That's $150,000 or $150 a month. That's another $20,000 worth of house that I can afford.
Right.
Just controlling where the house is and how I handle my insurance premium. And then lastly, of course, we had talked about earlier, the PMI. Get your credit in order. Get your credit in order before you buy a house. So if you are paying PMI, it's very low compared to being stuck with that big PMI note.
That's a whole nother PMI is a whole. We can talk about that in the same conversation we talk about the Fed.
Well,
PMI is a little bit of a mystery to folks
it
as
is a
well.
mystery, yeah, and I'd love to talk to folks about that and why it is. And it's because of the Fed, by the way, that it's there. But that's what you can control. You can control where you buy the house. You can control how you handle your homeowner's insurance. I can't tell you how many times a year, and it's very often, I will have a consumer say, okay, well, my homeowner's insurance is going to go with Bob's insurance agent because I've been using Bob's insurance agent for 20 years. And I'm like, well, okay, then the most you can afford to buy is $250,000. Oh my God, you know why? Well, because Bob's charging you $300 a month for homeowner's insurance. I would recommend you talk to Cindy and Tom's insurance and see what they can save you.
Mm-hmm.
And remarkably, could be 60, 70, $100,000. When you get into these really large houses, by the way, Kim, when you're talking to somebody that's buying a house approaching $1 million, homeowners insurance, wow.
Mm-hmm.
Wow. We're not talking about $100 a month difference now. We're talking about hundreds of dollars, maybe $300, $400 a month difference. Same thing with property taxes. If you're looking at $1 million home on one side of the county, property taxes might be $20,000 a year. Same house, other side of the county, different school district, might be $12,000 a year.
Right.
Big, huge difference.
Right.
Huge difference.
I don't think as a realtor that my clients, my buyer clients, take taxes or homeowners insurance into as much consideration as they do other factors. I mean, it's been drilled into consumers' minds that you need to have good credit, you need to have down money, et
Mhm.
cetera, et cetera. My experience is down money is the most solvable problem. You do need some,
Yeah.
but there are programs out there that are 100% financing. There are grants out there. So those are solvable problems. You cannot control the interest rate, but you can, like you said, like choose a home where the taxes are less. I absolutely try to guide my clients towards properties that have lower taxes because, especially if I do the math and discover that in fact you could try to appeal your taxes, but you likely will not get any benefit from doing that, then you're really stuck with that number. Oh, actually, you're not, because next year it's going to go up.
Right.
Every year, your property taxes are going up from that number. So those are factors that are, I think, overlooked by buyers a lot. Is the homeowner's insurance, and the thing you haven't touched on is the HOA fees.
Right. Yeah. So homeowners associations can be great and they can be the bane of your existence depending
Mhm.
on how you want to live. Some homeowners associations are very cheap, $25 a month or $300 a year. And that gets you generally a snowplow comes through to clean the roads in your development. They don't plow your driveway, by the way.
No,
Just, yeah.
common area maintenance
Right.
usually.
You might be living in a very upscale condo where you're paying three, four, $500 a month in homeowners association fees, but it comes with a indoor swimming pool and a huge banquet facility that you can use at will and
Right,
all kinds of things, a gymnasium and all this kind of stuff. Depending on lifestyle, it's all about lifestyle. If you need to have all those amenities, you're going to pay for it. Just understand that eats into how much that eats your borrowing power.
right.
Homeowners associations say, yeah, definitely.
Absolutely.
Yep, that eats your borrowing power
Yeah.
away.
So, I mean, I think this was helpful. I hope if anybody has questions about interest rates or questions about anything we've discussed, also, if you have a topic that you would like us to discuss, if you'd reach out and give us a comment, a like also, and a subscribe, that would be great. And we'll address your topic. And I think that's about it for today.
Well, all right then. I hope this is helpful. Remember, worry about the things you control. Don't worry about the things you can't control.
Right.
So until next time, I'm Ed Marko.
And I'm Kim Von Dohren.
You have been listening to Brick by Brick. Be sure and subscribe, post questions for future episodes, or comment. This is a Super Squirrel production, Super Squirrel Studios, Stony Creek Mills, Pennsylvania.